Let's learn about adjusting entries. But first, we need to review the accounting cycle. The first 4 steps of the accounting cycle are to analyze the business transactions to determine which accounts to debit and credit. Then we record the transaction in the journal. From there, we post the journal entries to the general ledger and make a trial balance to determine if debits equal credits. The next step is to look at these accounts. Some of the balances are not accurate, so we must adjust them. Adjusting entries are a necessary part of accrual-based accounting. They record changes in asset and liability accounts and also changes in their related revenue and expense accounts during the period, but haven't been recorded yet. After we prepare the trial balance, we look at those accounts and say, some of these account balances are not right. I need to adjust them so they will be accurate. Are you ready? Let's take a deeper dive into the accounts that need adjusting. Now remember, when we purchase supplies, we record them in an asset account, supplies. During the year, we use up part of those supplies, so we have to adjust the account balance to recognize the portion of those supplies that have been used up. For example, you purchased $560 of supplies at the beginning of the year. At the end of the year, you have $140 of supplies on hand. So how much have we used? The supplies adjustment calculation can be shown as follows. You start with the beginning balance of supplies, $560. Then you subtract the supplies on hand, $140. This leaves a balance of supplies used, $420. This is the amount of your adjustment. Your adjusting journal entry will include a debit to supplies expense for $420 and a credit to supplies for $420. Remember, debits must equal credits. Remember, not all accounts need adjusting. We're going to look at just a few. So the next one we're going to look at is prepaid insurance. When we buy an insurance policy, we pay the premium in advance. Thus, it is prepaid. During the year, time passes and the company no longer has the same amount of coverage remaining. It is necessary to adjust this account to reflect the amount of coverage the company still has. Asset accounts should always reflect what the company has, and expense accounts should reflect what has been used. For example, the Bright Company buys a 1-year insurance policy for $2,400 on September 1st. It is now December 31st. From September 1st to December 31st is 4 months. To calculate the insurance adjustment, first you must convert the insurance payment to a monthly amount. $2,400 divided by 12 months equals $200 per month. Look to see how long you have owned the policy. Again, September 1 to December 31 is 4 months. Last, multiply the monthly amount times the number of months the company has owned the policy. 200 times 4 months equals $800, and this is the amount of expired insurance and the amount of your adjustment. Your adjusting journal entry will look like this: a debit to insurance expense for $800 and a credit to prepaid insurance for $800. Your insurance expense is an expense account, goes up with a debit, and shows up on your income statement. Your prepaid insurance account is an asset account. Normal balance is also a debit, and it will show up on the balance sheet. The next adjustment we'll look at is depreciation of fixed assets. Depreciation is the allocation of the cost of the asset over its useful life. A company must expense off the portion of the asset used in the period it was used. There are multiple depreciation methods. Today's focus is on the straight line method, so let's take a look at the formula. Asset cost minus residual value divided by the number of years of useful life equals our annual depreciation. In our example, the company purchases a new piece of equipment for $36,000. The equipment is expected to have a residual value of $4,000 and a 4-year useful life. To calculate, take $36,000 minus $4,000 divided by 4 years. That will equal $8,000 in annual depreciation. The adjusting journal entry for depreciation will look like this: a debit to depreciation expense for $8,000 and a credit to accumulated depreciation for $8,000. The depreciation expense account is an expense and will go on your income statement. Accumulated depreciation is a contra asset, meaning that it offsets the asset to which it is related, and it will appear on the balance sheet. The normal balance of this contra asset is a credit. Did you know if you didn't use the asset the entire year, you can't take a full year of depreciation expense? You must prorate the expense for the time period the asset was used. Another adjustment that must be made is for salaries. Salaries must be recorded in the period in which they occur. If your accounting period ends in the middle of a pay period, you must accrue the salaries for the period that is closing. Let's take a look at an example. Let's assume you have a 5-day work week, Monday through Friday. Salaries each day amount to $2,000. December 31st is on a Wednesday. Payday is every Friday. Step 1. Calculate the number of days in the month that is about to close. Monday, December 29th, Tuesday, December 30th, and Wednesday, December 31st are all in December, and that's 3 days. Next, multiply the daily wage times the number of days in the month closing. $2,000 per day times 3 days equals $6,000. This is the amount you need to accrue. Your journal entry will look like this: debit, salaries expense for $6,000, credit, salaries payable for $6,000. Remember, salaries expense is an expense account. Its normal balance is a debit, and it will go on your income statement. Salaries payable is a liability. Its normal balance is a credit, and it will appear on your balance sheet. The last adjustment we'll look at is for interest. The adjustment for interest can be for interest expense or interest revenue, depending on if you are the borrower or the lender. First, we need the formula to calculate simple interest. The formula is principal times rate times time equals our annual interest. Our example deals with interest expense. Suppose a company borrows $30,000 at 9% interest for 6 months on October 1. It is now December 31st, and you need to accrue interest for the accounting period that is about to close. There are 3 months in this period, October, November, and December, so we must accrue the interest for this time period. Remember, our formula is principal times rate times time. Our T in this example is for 1 year. Because we're only accruing interest for 3 months, we need to divide by 12 to prorate the interest. So 30,000 times 9% times 3 divided by 12 will give us $675 in interest expense. The journal entry to record the accrual of the interest expense on December 31st is a debit to interest expense for $675 and a credit to interest payable for $675. We hope you've enjoyed today's presentation on adjusting entries. Stay tuned for our next topic. But until then, remember, adjusting entries are a necessary part of the accrual basis of accounting.